I have been watching financial markets for over 4 decades. I have sat across from the people who move billions of dollars. I have read the reports that never reach the public. And I am telling you right now in the clearest language I can find that the thing most people are worried about is not the real danger. Everyone is watching the debt. Everyone is talking about the debt, but the debt is not what is going to change your life. What is going to change your life is something quieter, something slower. Something that has already started, and almost nobody is talking about it. I spent 19 days in Basel, Singapore and Tokyo last month. I sat in rooms with people whose job is to think 20 years ahead. These are not television personalities. These are not bloggers. These are the people who manage the reserves of entire nations. And I asked every single one of them the same question. I said, what keeps you up at night? Not the debt, not the deficit. What is the one thing that does not make the headlines but changes everything? And I got the same answer in every city, every single time, without hesitation. What I'm about to share with you has a direct consequence for every dollar sitting in your bank account right now. Not in 10 years, not after the next election. Now, the mechanism is already running, and what I heard in those rooms from those people is going to land on you in a very specific way. A way that most financial advisors have never warned their clients about, because most financial advisors have never sat in those rooms. They have never asked that question. And they have never heard that answer. Stay with me through every single minute of this video, because at the halfway point I am going to reveal the one number that changed what I personally did with my own portfolio when I came back from that trip. One number, it is not a prediction, it is a measurement, and once you see it you cannot unsee it. Do not skip ahead. What I show you first makes that halfway revelation land with the full weight it deserves. Subscribe right now before we go further, because I want you to be here when the next one comes. Let me start with the moment that changed everything for me on this trip. I was sitting in a private dining room in Singapore, dark wood paneling, no phones on the table, and there were 6 people in that room. Between them, they were responsible for allocating capital across 4 continents. These were not young men with opinions. These were men in their 50s and 60s who had lived through 1987, through 1997, through 2001, through 2008. Men who had seen what markets actually do when the mechanism breaks. I asked them the direct question. I said, if you had to pick one single risk that is not being priced into markets right now, what would it be? And the man at the end of the table, a man who has managed sovereign wealth for 30 years, looked at me and said 7 words. He said, trust is leaving the system very quietly. He did not say the debt is too high. He did not say interest rates are going to break something. He said trust is leaving the system quietly. I heard the same thing 3 days later in Tokyo. Different room, different people, same answer. I asked a woman who advises central banks on reserve management. I asked her what she is watching that is not in the news. She said the same thing in different words. She said the willingness to hold each other's obligations is declining. Trust, confidence, the invisible glue that holds the entire financial system together. It is leaving. And it is leaving quietly enough that most people will not notice until they cannot ignore it. Tone lower, slower. Now I want to tell you something that I have never shared publicly before, because I think it matters that you understand I have been wrong about this before, badly wrong, in a way that cost me everything I had at the time. It was 1982, I was 31 years old. I had been studying markets for nearly a decade. I had read everything. I thought I understood cycles. I thought I understood how things break. And I made a bet, a large bet. I borrowed money to make it. $4,000 from my father who did not have it to spare. My wife and 2 young children depended on me. And I was certain. I was more certain than I have ever been about anything in my professional life. I was certain the dollar was about to collapse. I was certain the debt spiral was terminal. I built an entire portfolio around that conviction. And I was wrong, not wrong about the direction, wrong about the timing. The dollar did not collapse in 1982. Paul Volcker raised interest rates to nearly 20%. The system found a way to survive, it found a way to reset, and I lost almost everything. I had to call my father and tell him I could not pay him back yet. I had to look at my wife and tell her we were starting over. That failure taught me the most important lesson of my career. I lear. Ned, that the most dangerous financial events in history never feel dangerous when they happen. They feel manageable. They feel temporary. People inside a system will refuse to see that the system is breaking for far longer than any rational observer would expect. And the person who bets on the exact moment of the break will be wrong and broke long before the break actually comes. That lesson changed everything about how I think. I stopped asking when. I started asking what. And I started asking, how do I position myself so that when it happens, I am still standing? Now let me show you exactly what is happening with the thing nobody is naming correctly. Everyone calls it a debt problem. And yes, the United States government owes more than $36 trillion right now. That number is real, that number matters. But the debt is not the mechanism that is going to change your daily life. The debt is the symptom. The mechanism is what happens to trust when people start to doubt that the debt will ever be meaningfully repaid. Here is how a financial system actually works. At its core, it is a trust system. When you put money in a bank, you trust the bank. When you buy a government bond, you trust the government. When the whole world uses the dollar to buy oil and gold and soybeans, every country in the world is trusting the United States to maintain the value of that dollar. They are trusting the United States to behave responsibly, to not print so many dollars that each one becomes worth less. That trust is the real asset, not the gold in the vault, not the GDP number, the trust. And trust, once it starts to leave, accelerates. It does not leave and then come back easily. It leaves in a way that looks slow at first, and then all at once. And here is the revelation I promised you at the halfway point. When I came back from that trip, I pulled every number I could find on what the people who manage the world's reserves are actually doing. Not what they are saying publicly, what they are actually doing with real money. And here is the number that changed my own positioning when I saw it. Central banks around the world bought more gold in 2022 and 2023 than in any two-year period in the last 50 years. More than at any point since countries were still on the gold standard. Over 1,000 tons per year, 2 years in a row. And in 2024, the pace did not slow down, it continued. The people whose entire job is to protect the value of national savings, the people who have access to every model, every projection, every private briefing that exists, those people are moving out of dollars and into gold at the fastest pace in half a century. Now let me give you the comparison that makes this concrete. The S&P 500 right now is trading at approximately 35 times earnings. That means for every dollar of profit that American companies produce, you are paying $35 to own a share of that profit. The last time the S&P traded at this level was the peak of the dot-com bubble in the year 2000. Goldman Sachs has projected that at these valuation levels, the S&P 500 will return approximately 3% per year over the next 10 years before inflation. 3% per year for 10 years. Meanwhile, gold has risen approximately 80% over the last 3 years, and the people moving billions of dollars, the people I sat with in Singapore and Tokyo, are not doing that because they love gold. They are doing it because they are losing trust in the alternative. They are losing trust in the promise that the dollar will hold its value. They are losing trust in the promise that American debt will be honored without the slow shrinking of what each dollar can buy. They are moving into gold because they see what is happening to trust, and they are acting before the public notices. That is not a conspiracy. That is not exotic. That is what people with the best information in the world are doing with their own money right now, and that is the part nobody is talking about. Now let me give you the historical context, because I want you to feel the weight of this pattern, not to panic you, but because if you do not understand the pattern, you will not understand why this time is following the same road that every other time has followed. 500 years of financial history show us one repeating pattern. Every great reserve currency eventually loses its status. Every empire that issues the world's dominant money eventually spends more than it can produce, and when it does, it faces a choice. It can accept the pain of cutting spending and raising taxes and going through a long, slow recession, or it can do what is easier in the short term. It can print more money. It can let the slow shrinking of what money can buy absorb the cost of the debt. It can let you pay for the debt through inflation without ever calling it a tax. Every single dominant empire in modern history eventually chose the easier path. Not because their leaders were evil, because the political pressure to avoid short-term pain is always stronger than the rational case for long-term discipline. In 1923 in Germany, the Weimar government faced an impossible debt burden from the First World War. The reparations demanded by the Treaty of Versailles were more than Germany could pay through taxation, so the government printed money. At first it was small, then it was not. By November of 1923, a loaf of bread cost 200 billion German marks. People were bringing wheelbarrows of cash to buy groceries. The people who held their savings in German marks lost everything. The people who had moved their savings into gold or foreign currency or real productive assets kept their wealth. The mechanism was not complicated. The government needed to pay its debts. It printed the money. Each mark became worth less until it was worth nothing. In 1971, Richard Nixon ended the Bretton Woods Agreement. For 25 years after World War II, every dollar in circulation was backed by a specific amount of gold. Countries could take their dollars to the United States and exchange them for gold at $35 an ounce. That promise kept the system honest. It forced the United States to behave responsibly with money because every dollar printed had to be backed by real gold in the vault. But by 1971, the United States had spent so much money on the Vietnam War and on social programs at home that it could not honor the promise anymore. Nixon ended it. He told the world that dollars would no longer be convertible to gold. The world kept using dollars because there was no better option. But the anchor was gone. The discipline was gone. And in the decade that followed, the United States experienced the worst inflation since the Great Depression. Prices rose more than 100% between 1972 and 1982. Your grocery bill doubled. Your purchasing power was cut in half, not because anyone stole from you directly, because the government chose a path that made each dollar worth less. In 1956, Britain learned what happens when a reserve currency loses trust. The British pound had been the world's reserve currency for over a century. It was the dollar before the dollar. Britain went into debt to finance 2 world wars. After the Suez Crisis in 1956, when the United States forced Britain to back down from military action in Egypt, the world suddenly saw that British power was limited. The pound began to lose its status almost immediately. Over the following decade, the pound fell sharply against other currencies. British people who held their savings in pounds watched their wealth shrink in global terms. The empire had ended. The currency followed. The pattern in every single one of these cases is the same. The most dangerous part is not the moment of collapse. The most dangerous part is the long, slow period before the collapse when nothing looks wrong, when the grocery bill is a little higher but not catastrophically higher, when the stock market is still going up, when the numbers in your account look bigger even as what those numbers can actually buy is quietly going down. That is where we are right now. And that is what the people I spoke with in Singapore and Tokyo are positioning themselves for. Now let me show you exactly what is happening right now in the present, not in 1923, not in 1971, right now. In the last 3 years, foreign central banks have reduced their holdings of United States Treasury bonds by more than $700 billion. These are the countries that used to recycle their trade surpluses back into American debt. China alone has reduced its treasury holdings by nearly $300 billion over the last 4 years. Japan has been quietly selling as well. The demand for American debt from the biggest buyers in the world is declining. At the same time, the United States government is spending approximately $2 trillion more per year than it collects in taxes. That is the current deficit, and the interest payment on the existing debt is now over $1 trillion per year. For the first time in history, the United States is spending more on interest payments than on its entire defense budget. The interest payment alone, not the debt, just the interest. And here is what that means for you personally. When the government needs to borrow more money and the biggest traditional buyers are buying less, it has to find other buyers. It has to raise the interest rate it offers to make the debt attractive. But higher interest rates mean higher borrowing costs across the entire economy. Your mortgage costs more, your car loan costs more. Small businesses borrow at higher rates and hire fewer people. Or the Federal Reserve steps in and buys the debt itself by printing new money, which makes each dollar you hold worth a little less. Either way you pay through higher borrowing costs or you pay through the slow shrinking of what your dollar buys. Your grocery bill has risen approximately 30% over the last 4 years. That is not random. That is not just supply chain problems. That is the cumulative effect of money supply expansion meeting declining trust in the dollar's purchasing power. The gap between what powerful people know and what you are being told is real. The people I sat with in Singapore are not worried about their grocery bills. They moved out of that exposure years ago. They are making very different decisions with their own money than the advice that flows through mainstream financial channels. Central banks bought more gold in 2022 than in any single year since 1967. Gold has risen more than 80% in the last 3 years, while the interest rate on a savings account barely kept pace with even the official inflation number. And the official inflation number, by the way, is measured differently today than it was in 1980. If you measured inflation the same way they measured it in 1980, the current rate would be significantly higher than the official number you see in the headlines. This is not a theory. The methodology changed, the outputs changed, and the gap between what the number says and what you feel at the grocery store is not an accident. Now let me tell you exactly what to do, not what you should do, what I personally did when I came back from that trip, what I did with my own money based on everything I heard and everything I have spent 40 years learning. This is not financial advice. I am not your financial advisor. Please speak to a licensed professional before you do anything, but you ask me what I see, and I will tell you what I did. Action 1. I moved 15% of my portfolio into physical gold and gold-backed instruments. Not a speculative position, a protection position. The specific instruments I use are GLD and IAU. These are exchange-traded funds that hold actual physical gold in vaults. They trade on standard brokerage accounts. You do not need a special account. You do not need a broker in Switzerland. These are available to any person with a standard investment account at any major brokerage. I moved 15% in because at current valuations, and with current central bank behavior, I believe gold is the most direct hedge against declining trust in paper money. These are not exotic instruments. These are the instruments that the people who understand the mechanism use to protect themselves. Action 2. I reduced my exposure to long-duration U.S. Treasury bonds to under 5% of my portfolio. Long-duration bonds are the instruments most sensitive to the trust problem I described. If trust declines and interest rates rise further to attract buyers, the value of existing long-duration bonds falls significantly. For every 1% rise in long-term interest rates, a 20-year Treasury bond loses approximately 18% of its value. I did not eliminate treasuries entirely because they still serve a purpose in crisis liquidity, but I reduced the duration and the allocation. Action 3. I moved 10% of my equity allocation from U.S. domestic equities into international equities, specifically using VXUS, which is Vanguard's total international stock market fund. The United States stock market is trading at 35 times earnings. International developed markets outside the United States are trading at approximately 14 times earnings. Emerging markets are trading at 12 times earnings. Goldman Sachs projects that the U.S. market, at current valuations, will return approximately 3% per year over the next decade. International markets at current valuations project significantly higher returns by the same methodology. The valuation gap between the U.S. market and the rest of the world is at its widest level in modern history. That does not mean the US market will fall tomorrow. But it does mean that the expected return from international equities relative to US equities favors diversification right now in a way that has rarely been clearer. Action 4. I built a position in Treasury inflation-protected securities, commonly known as TIPS. The ticker is TIP. These are government bonds that automatically adjust their principal value based on the official inflation rate. If inflation rises, the value of your bond rises with it. They are not a perfect hedge because they use the official CPI measurement, which, as I mentioned, is calculated differently than historical measurements. But they are far better than a standard bond or a savings account as protection against the slow shrinking of purchasing power. I currently hold approximately 8% of my portfolio in TIPS. I consider them a floor, a way to make sure that even if the official inflation number stays elevated, my fixed income position does not get destroyed in real purchasing power terms. Action 5. I kept a meaningful position in energy infrastructure, specifically through VDE, which is Vanguard's energy ETF. The reason is simple. Energy is priced in dollars globally. When the dollar weakens, energy prices tend to rise in dollar terms. Energy companies that produce oil and gas in the United States benefit directly when the dollar loses value. This is a partial natural hedge against dollar debasement. It is not perfect. Nothing is. But at a time when trust in the dollar is declining, having exposure to assets that rise in dollar terms when the dollar falls is basic structural protection. These are not exotic instruments. These are the instruments that the people who understand the mechanism use to protect themselves. The window is closing, not tomorrow, not next week, but the mechanism is running. The central banks of the world are telling you exactly what they think is coming through their actions. They are buying gold, they are reducing dollar holdings, they are preparing for a world where the dollar's dominance is less certain. They are not panicking, they are not selling everything. They are quietly, deliberately, over years repositioning. And that repositioning is the clearest signal I have ever seen in 40 years of watching these markets. This is not like 1982 when I was wrong about the timing. I am not making a timing call. I am not saying the dollar collapses in March. I am saying the mechanism is running. I am saying the evidence is clear. I am saying that the specific actions of the most informed capital allocators on the planet are telling a story that the headlines are not telling. And I cannot stay silent anymore. You asked me to tell you what I see. I told you. I traveled 19 days. I sat in 3 cities. I spoke with the people who move the money that moves the world, and they all said the same thing. Trust is leaving the system, quietly. And when trust leaves quietly, it leaves for a long time before anyone notices, and then it leaves all at once. The people who prepared kept their wealth. The people who waited for the headlines lost theirs. That is not a prediction. That is 500 years of history repeated so many times that the pattern is not even controversial among the people who study it. The only question is whether you are paying attention early enough to matter. I just told you that the real threat is not the debt. It is the trust. And here is what that means for your money in one sentence. When the people with the best information in the world move out of the world's reserve currency and into gold at the fastest pace in 50 years, the correct response is not to do nothing and hope your savings account keeps up. The correct response is to understand the mechanism, to understand why it is happening, and to make deliberate, measured, non-panicked adjustments that protect what you have built over a lifetime of work, not gambling, not predicting, protecting. If you found this useful, subscribe right now. I read every single comment personally. And I want to ask you one specific question. What percentage of your portfolio is currently outside the United States? Not a complicated question, just a number. If your answer is 0, write 0. If your answer is 10%, write 10. I want to see where you are, because that number tells me what the next video I need to make for you actually is. Write your number below, just the number, nothing else. I read them all. Stay with me. The next video will go deeper into exactly which international markets are showing the specific setup that the people I spoke with are watching most carefully right now. And I will tell you why one specific country no one is talking about is the place where I believe the most significant opportunity of the next decade is quietly forming. Subscribe so you do not miss it. I will see you there.